Now, despite the trials of the past year, life has actually been pretty good in Australia over recent decades. Homeowners have seen prices rise while mortgage rates have been dropping. Stock market investors have enjoyed a steady and growing dividend stream, coupled with some pretty incredible returns actually from the sale of public assets. Think about this for a moment. CSL, that's the Commonwealth Serum Laboratories. It was sold by the government at $2.30 per share in 1994. Recently, it traded over $300 per share. And that's after a 3-for-1 stock split. It's turned 80 cents into $360. If you bought in the float and you still held it, you would have made about 400 times your money in only a few decades. And it's even better in things like Bitcoin, if you know what that is. In less than a decade, you could have turned about $1,000 into more than $1 billion. Shouldn't we have all listened to those tech nerds about now? Anyway, even if you'd had all your money in bonds for the last 20 years, you still would have made outsized returns as interest rates fell. So in short, it hasn't mattered where you've invested your money, in bonds or gold or stock or property, you've actually made a poultice along the way. But every run in investment markets come to an end, and in the investment markets, the end is usually more of a bang than a whimper. Years of accumulated wealth can disappear overnight as prices fall, and of course financial experts all differ on what the future holds. But there are some very, very clear markers that every investor needs to consider. Interest rates are around 5,000-year lows. I'm betting they're not going to go that much lower. But it allows people to borrow very cheaply, and it means that they'll accept lower returns on their investments to finance their borrowings, which in turn pushes up the value of asset prices. We've even got negative interest rates, which means people are lending money to governments for 10, 20, 30, 50, or in some cases 100 years. And some of them expect to get less back than they put in the first place. To me, that is plain crazy. And governments around the world are also printing money, which eventually has to find a home somewhere. It's no good leaving it in the bank, as many of you would know, because there's no real return there. And it means a lot of money flows into investments, which pushes them all higher again. The entire world, and I mean government, business and consumers, is awash in a sea of debt. I think it's as close to a perpetual borrowing binge as we've ever seen. But the hard truth is that all debts have to be repaid eventually. And they're either paid by the borrower, they're defaulted on, which means the lender is actually paying, or it's eroded by inflation. And that's what governments are currently desperate to do, create inflation to make their problems go away. But of course, inflation means that interest rates are going to rise, making your borrowing repayments higher, which may change asset valuations to change, as causing your investments to actually fall in price. It's a catch-22 in what looks to be a perfect financial storm. And most Australians won't even see it coming. Well, one financial strategist thinks we are trapped in a global asset bubble, which is going to come to an end with an almighty thump. He's a best-selling author who called the bust of the Japanese bubble in 1989. He predicted the dot-com crash of 2000, and even predicted Donald Trump's presidency. Now, he's saying we could be in the biggest crash ever. Harry Dent joins me now. Harry, thanks so much for your time. Tell me how you think this Thank you. Tell me how you think this investment boom is going to end.
Well, it ends from its own excesses. Now, also, there can be events that trigger it. China is trying to taper their bubble, and they're the biggest bubble in the world. And of course, they're your biggest customer. So that's one of the events now. But stocks have just gotten so crazy, and real estate, people, it's got to be in Australia too. People are just standing in line. You see a piece of real estate you like, you don't make an offer in 10 minutes, it's gone, not because there's so much demand, there's no supply. Builders haven't been building since the Great Recession and stuff. So what's really happening here, Cory, I mean, yes, inflating gets you out of debts, but what the governments really did in late 2008 and 9, when the recession started to look like a depression, which is what I was forecasting at the time, they just panicked and said, well, wait a minute. They printed tons of money to save the banks. And what they realized was, wait a minute, the key here, saving the banks fine, but nobody wants to borrow money from them, not corporations or consumers, because they all borrowed so much in the great bubble into 2007. So they realized by putting money into financial assets, by buying bonds, you push up stocks and real estate and bonds. Like you said, everybody's made outsized returns and everything. And that at least makes the top 20% that own 90% of stocks and the great majority of real estate richer, and they spend more money. The everyday person hasn't been getting much benefit from this stimulus because they don't own a lot of stocks. Now, the everyday person in Australia has gotten more benefits because your real estate bubble has been the stronger bubble for you. The stock bubble's been strong in the U.S. But like you said, $525 trillion. I want to repeat that number. $525 trillion in financial assets in the world. It was 300 before the Great Recession, and that is 6.5 times GDP when it ought to be 1.5 to 2. So we're going to have a great reset. I think it's going to happen between now and the end of 2022. It's going to start by the end of this year and possibly in the next week or two. I got a lot of indicators right now, including Bitcoin making a new high but looking weak, which would be a signal that says this could be starting to happen now. If you do not get out of the way and get into safe government bonds, Australian or U.S., or cash, or in apartment rental, real estate and medical things that hold up, I'm telling you, stocks could go down 70 to 90%, real estate 40 to 50. The stocks will happen, like you say, within 2 years or something. People will not see this coming. It hasn't happened. They stopped it in 2008-9 with this massive stimulus, and then they never stopped. We've had 12 years of nonstop money printing by all the central banks in the world, and now we have massive, especially in the U.S., $5.1 trillion already of fiscal stimulus in 1 year on top of $4 trillion of money printing, and they got $2 trillion more coming in infrastructure plans here. That's 55% of GDP. That's how much they're having to stimulate to keep a dead economy going. Our economy died in 2008-9, and nobody announced the funeral. So I've been reminding people ever since. This artificial bubble, the first bubble in 2007 was a real bubble. This is totally artificial, which makes it more dangerous.
But Harry, every time there's a new stimulus, they have to put more money in to get less economic bang for their buck.
Exactly.
I'm concerned, you just said, I want to ask you, but you suggested that people need to be in cash or bonds. But surely if inflation comes along and people are in bonds, the yield on bonds goes up and that means the value goes down. So that could be a loser for people as well, couldn't it?
Well, it could be, but people, I have to debate the gold bugs, and I've done it in Australia as well. Peter Schiff and Jim Rickards. They realize that you can't get something for nothing and grow an economy on printing money and stuff, and there's a consequence. They don't realize the real problem here is no longer the debt bubble, which is about half that, 3.3 times GDP, about 330 trillion. It's the financial asset bubble. To fight the debt bubble from restructuring and bursting and killing the economy, which it always does. It kills companies and banks and jobs temporarily to get rid of a lot of unproductive debt. It's the financial asset bubble. They've blown up financial assets way more. So when these financial assets, which includes loans and bonds, when they deflate and go back down, they're going to go down about 50%. Guess what? That's $250+ trillion disappears from the world economy. This is real money, not in your bank account to pay bills, but in your brokerage accounts and your real estate equity that you can borrow against. People are going to feel a lot less wealthy, especially the top 10 to 20%, which, by the way, control 50% of consumer spending. They might be 20% of consumers, but they're 50% of the spending because of their outsized spending, their outsized real estate ownership, and their way outsized stock ownership. So this is what's going to happen. This causes deflation. This is going to be like the 1930s style financial crisis, not like the 1970s inflationary crisis. And that's what gold bugs miss.
So, Harry, what should they be doing to prepare themselves? You don't know the future. We can only play the odds. But how would you be suggesting to people that they should be investing their assets?
Well, first of all, since this is a great reset of all financial assets, only cash, the best currencies, which will include the U.S. dollar in Australia, because Australia has the least debt of any major developed country, that's where the money will run. Their bonds, because the money has to run somewhere, but there's very few alternatives. That's why I say, no, number one, if you're more aggressive, willing to take some risk, if you simply buy an inverse fund in a major like ASX 200 index or Australian ordinaries or the NASDAQ, the QQQs they call it, if you can buy an inverse index that will just simply go down when stocks go down. When people listen to me and Peter Schiff and say, well, you both sound intelligent, I don't know which one's right. One says inflation, one says deflation. Stocks go down under either circumstance. It's bonds that do the best if it's a deflationary outcome. Quality bonds, 30-year Treasury bond in the U.S. or the longest updated government Australian bonds will hold up the best. And cash, if you're just sitting in cash, just for a couple of years. I'm not telling people to get out of investments in the markets or real estate forever. Just a couple of years till this reset happens. Those assets go down and you will buy much more. That's all Joseph Kennedy did at the 1929 top. He got out and reinvested when stocks, now note this number, down blue chip stocks, the best stocks, not small caps, down 89% before the bottom. Imagine if you'd have been in cash and then rebought General Motors and Ford and RCA, the leading companies of the time, and 89% off, how rich you would have been fast.
Well, Harry Dent, it's going to be interesting to watch this space. You said it could happen in the next couple of weeks, but it should play out over the rest of this year. You'll be a hero if you're right. And of course, I'll be inundated with people telling me why you're wrong. It'll be a fascinating debate to watch. Harry Dent, I've really appreciated the chat tonight.
Yeah, people get more information from us at dentsectorfund.com. We got a new mutual fund only for Australia, and we also have an online webinar series people can get on and learn more.
Okay, what's the website again?
dentsectorfund.com.
dentsectorfund.com. Harry Dent, thanks so much for your time tonight.
Thank you, Cory.